Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 8, the problems for group B. Come on. All right, come on. Technology, it's a wonder. All right, there we go. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problems. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And just as a quick aside, this chapter, since it's on long-term assets, what happens in this chapter is concepts building upon previous concepts, meaning, for example, amortization is nothing more than depreciation, and the calculations that you do for depreciation, such as straight line or whatever have you, have already been covered. All right, so I'm not going to keep on going over stuff that's already been covered. I'm only going to cover new stuff. So if you don't realize that if you're missing something, like you don't understand how I'm arriving at an answer because of a calculation that I've done, then that means you need to go back and rewatch the theory videos that pertain to that particular concept. Okay, so I'm only going to cover new stuff. All right, so the first problem here is 54, and it says Russell Freightway provides freight services. The company's balance sheet includes land, buildings, and motor carrier equipment. Russell uses a separate accumulated depreciation account for each depreciable asset. During 2012, Russell Freightway completed the following transactions. And so number one, record the transactions in the journal, round your depreciation expense to the nearest whole dollar. Okay, so on January 1, traded in a motor carrier equipment with accumulated depreciation of $85,000, cost of $132,000 for new equipment with a cash cost of $174,000. Russell received a trade-in allowance of $64,000 on the old equipment and paid the remainder in cash. Okay, so if you recall from the theory videos, in doing this kind of work, I like to take off the old first, put on the new, and then back into whatever I have to as far as the gain and loss. Okay, so it's kind of like a three-step process. All right, so, and also I'm going to end up erasing each journal entry, so once the journal entry is complete, pause the video, write it down if you have to, because I'm going to end up erasing it. So on 1-1, what do we have here? He traded in a motor carrier equipment with accumulated depreciation of $85,000. The cost was $132,000 for new equipment. So the motor carrier equipment with accumulated depreciation of $85,000 and the cost is $132,000. So on our balance sheet, we would have, motor carrier equipment, and it would show the cost being $132,000 and the accumulated depreciation would be $85,000. Okay, so that would be, let's see here, 132 minus 65, oops, sorry, 132 minus 85 is the book value ended up being $47,000. Okay, so that's what it looks like on the balance sheet. So we're going to have to remove the motor carrier equipment. All right, so that's a debit. And to remove it, we're going to credit it. So motor carrier equipment gets a credit of 132,000, and the accumulate depreciation is a credit, so we have to debit that. So we're going to debit the accumulated depreciation for 85,000. Okay, so that's the removal of, remember I said it's a three-step process. Number one, we get rid of what was on the balance sheet. Okay, in other words, we zero amount, we take it off the balance sheet. Number two, we add anything new that we're going to put in. So we're going to add in, let me erase this up here so we don't confuse issues. So for number two, I'll do that in blue, we traded in for new equipment with a cash cost of 174,000. So if we're adding that to our balance sheet, we have motor carrier equipment new. Okay. This one here would be old. And we're going to add that for 174,000. Okay. Excuse me. Russell received a trade-in allowance of 64,000 on the old equipment and paid the remainder in cash. Okay, so so that was step number two. We added in the new equipment. Now number three, we figure out, well actually maybe, and we're still on number two because I didn't finish working with, sorry about that. We're still on number two here where we're working with, I added the equipment, but I have to deal with the cash aspect of it. So if the new equipment cost 174,000 and we receive a trade-in allowance of 64,000, that means we're going to end up paying $110,000 in cash. So we're going to credit our cash for 110,000. Okay, so that's all part of number two. Okay, now number three is to deal with the gain or loss. Well, again, you can memorize this if you want. All right. Oh, a gain is a credit, and a loss is a debit, and then try to remember the concept behind it or whatever. But the easier way to deal with this is to say to yourself, okay, I have debits and I have credits, all right? And excuse me. So in order to balance the journal entry, which would give me my gain or loss, okay, I have to just add up my debits and add up my credits and then take the difference between the two. So my debits are 259,000, and my credits are 242,000. And the difference between the two is $17,000 difference between the two. But notice that my debits are greater than my credits, so that means I have to make a credit for the gain on exchange of equipment for $17,000. Okay, and that is my journal entry for it. Okay, that's all there is to it. So go through the three-step process. One, take off the books the old equipment. Then number two, add what you do for the new equipment. And then number three, calculate the gain or loss. And that's just basically backing into that amount. Make sure you use the correct terminology, gain on exchange of equipment, okay, when you're making that journal entry. You should put on exchange of equipment. If someone puts gain on equipment, that's fine, but really it's an exchange here. So or gain on purchase of the new equipment or whatever. Okay, don't just put gain. All right, or don't just put equipment. That isn't, you know, you have to. There is a general ledger account, and this is where you start getting into the little bit higher level of accounting, where yeah, you have your chart of accounts, and your accounts are not as simplistic as they were before. Okay, so that's the journal entry for January 1st. All right, so I'm erasing this. All right, July 1st, so 7/1. It says sold the building. That cost $570,000 and had accumulated depreciation of $240,000 through December 31st of the preceding year. Depreciation is computed on a straight line basis. The building has a 40-year-old useful life and a residual value of $80,000. Russell received $100,000 in cash and a $590,000 note receivable. Okay, so the cost on the building is $570,000 and had accumulated depreciation of $240,000 through December 31st of the preceding year. Okay, well, this is July 1st, so 6 months have gone by, and that if this amount of $240,000, which goes through December 31st, that's not an up-to-date amount, so we have to make our journal entry for the accumulated depreciation in order to get that up to date. So let's see here. The building has a 40-year useful life and a residual value of $80,000. So it's the building is $570,000, and okay, so excuse me there for the pause. As you can hear, my voice isn't so well, but anyway, the cost on the building is $570,000, $80,000 in residual value, which gives me $490,000 that we're going to depreciate. We depreciate it for 40 years. Whatever you get for that answer, right? So you divide the 490 by 40,000. Actually, let me just do it. 490 divided by 40 gives me $12,250. Okay, that's per year. So we're going to have to take the 12,250 and multiply it by 6/12 because we have 6 months to get to July. All right, and that gives me approximately $6,124 and some cents. So I'm rounding to 6,125. Okay, so my entry to update my depreciation will be depreciation expense will be 6,125. Then accumulated depreciation will be 6,125. And this here is going accumulate depreciation building. Okay, so that's my entry for the depreciation. Now, with that updated, now we can do step number 1, which is to take off what is already on the books. So I have a building for $570,000. That's a debit. So I can take my building and credit it for $570,000. Right? And then my accumulate depreciation, which was a credit, I'm going to end up debiting accumulate depreciation, and that is $240,000 plus the 6,125. Okay, so that's $246,125. Right, the $240,000, which was already on the books till December, plus this additional $6,125. That brings us up to July 1st. Okay, so there's, we took the building off the books. Okay, now, we're going to, since, let's see here, since we sold the building, all right, obviously we're not replacing with something else, all right, we're not replacing with a new building. However, we do have, you know, we're not at the gain or loss portion yet. We have to record what we get, okay? So it says here that Russell received $100,000 in cash and a $590,000 note receivable. So we're going to debit our cash for $100,000, and we're going to debit a note receivable for $590,000. Okay, so that's step number 2, adding what we had gotten. Right now, step number 3 is recording the gain or loss. And remember, the recording of the gain or loss, the easy way to do it is to just go and say, okay, what's my debits, what's my credits, and what's the difference between the two? So on the debit side, I have 100,000 plus 246,125 plus 590,000, and that gives me 936,125. And obviously on the credit side I have 570,000. So if I subtract 570 from the 936,125, I end up with 366,125. Okay, so that's going to be my gain on the sale of building. Gain on sale of building. And that, I said, was $366,125. Okay, and that's my journal entry in order to record the sale of the building. Right. So, excuse me. So for this journal entry, to quickly recap, you know, we know how much the building costs and the accumulated depreciation, but we have to update our accumulated depreciation to make sure it's current. So we ended up making that journal entry. We had to calculate the depreciation for the additional 6 months and put it on our books. And when we did, that changed the amount of the accumulated depreciation from 240,000 to 246,125. Now, when we go to, you know, we're selling the building, so we have to take the building off, and we have to, you know, consider what we're getting. Okay, doesn't necessarily mean that you have to replace it with exactly, you know, a new building. You know, it all depends upon the transaction, and that's why you can look in a book all you want and try to, you know, have a new problem. Look in a book all you want, but if you don't understand the concepts, you're not able to work the problem because you're trying to find the exact journal entries in the book. You're never going to find it. Each situation is different. So in this case here, they're selling off the building, so we have to, number one, we're going to take the building and the accumulated depreciation off of the books. Okay. Number two, we are going to add what we received, which was the cash and the notes receivable for that building. And then number three, we calculate the gain or loss on the sale of the building. And remember, the gain or loss is nothing more than backing into that amount, right? By saying, okay, well, what's my total debits? What's my total credits? The difference between the two to make my journal entry balance is how much that gain or loss is. All right. So I'm going to erase this. Yeah, I'm been sick now for a week, or at least it's in my throat, and it's like from all the hacking and coughing and whatever have you. So you'll have to excuse that. All right. So now October 31st, we have purchased land and a building for a cash payment of $900,000. An independent appraisal valued the land at $331,200 and the building at $703,800. Excuse me. Okay, so all right, the first thing that we're going to do is we're going to say, okay, in this case, we're purchasing for a cash payment, we're purchasing land and a building for a cash payment of $900,000. So we're going to credit our cash for $900,000. And now we want to record the land and the building. And the appraised value is $331,000 and $703,000. $331,000, $200,000, and $703,800. 00053. So that comes out to $1,035,000. All right. Now we only paid $900,000. All right. We can't record that profit because that's just an appraised value. It's an opinion. Okay. As to the value of that property. However, it has to be, out of this 900,000, where is it here? Out of this 900,000, we have to apportion it correctly between the land and the building. So if the land is 331,000 and the building is 703,000, to get that percentage of each, I'll take the 331,200 and divide it by the 1,035,000 and get, so I'm taking the 331,200, this is for the land, and I'm dividing it by the 1,035,000, and I end up with 32%. Okay, so the land is worth 32%, and the building is 68%, which gives us a total of 100%, right? Because $1,035,000 is 100%. This is your basic math from business and finance. So if you're not getting this portion concept, go back and look at the math for business and finance section theory for that. All right. So we're saying our land is 32% of the total appraised value, and the building is 68% of the total appraised value. So if I paid cash of 900,000, 900,000 times 32%. Let me write that neater. 32% gives me 288,000. Okay, so that's going to be the amount that we're going to record the land for, 288,000. And of course, the building is going to be the difference between the two. So 900,000 less 288 gives me 612,000. So the building is worth 612,000. Okay, as an apportioned. Right. So that's it for the October 31st entry, and I'm going to erase it. And now move on to the December 31st entry. So on December 31st, recorded depreciation as follows. New motor equipment has an expected useful life of 800,000 miles and an estimated residual value of 22,000. Depreciation method is units of production. During the year, Russell drove the truck 100,000 miles. Okay. Depreciation on the building is straight line. The new building is 40-year-old and residual value of 60. So the motor carrier equipment, the truck, is separate from the building in and of itself. Remember, land is not depreciated. And so we're using units of production for the motor carrier equipment. Has an expected useful life of 800,000. So if we go back to our journal entry for the motor carrier equipment, right? Excuse me.